Good morning, everyone. I'm Roberta Robinson, and I'm very happy to have you attend our first ever webinar on Zoom. We're living in a new world. We all know that. And for those of you who have never been on a Zoom conference, congratulate you for getting in. You're probably wondering, how are we practicing law in this environment? We've definitely had to adapt. We are in the office. We are having telephone conferences, web conferences through Zoom. It's interesting because this allows us to talk to people all over the country. And I'm thinking one day it'll be all over the world. It's really changed things. We meet in person really only to sign documents in our special conference room with the doors open and the windows open. Briefly, because everything is already approved and read and revised by the time someone comes in to sign documents. So we are in a new world. We have another webinar that's going to be coming up in January, on January 27th, and you will receive an email invitation. It's our What's New seminar. We always have done this for decades in person. Here in Rancho Bernardo, but now we're going to be on the internet doing our presentation where we talk about recent developments in estate and trust law from the last year and going forward. We decided to have a special presentation today because there have been some significant changes, California and federal. Our election, can you believe, was only about 2 weeks ago. Doesn't it feel like it was a couple months ago? Well, it was only 2 weeks ago. We live in kind of a compressed time world. And we are going to go over today the impact of the federal election and the California election on estate planning. We're going to go over what we know, and we're going to go over what we don't know. And believe me, that is a big category, what we don't know yet. And how to plan in this environment, or how to even think about planning. What are the questions to ask? Daniel, next slide, please. So I would be remiss as a lawyer if we didn't put a disclaimer slide in. What's this all about? We are explaining the law, the state of the law. Does it apply to you personally? Well, everybody has their own circumstances, their own facts. So we are trying to give you an overview. How this applies to you personally really means talking with us or your advisors one-on-one. Let's go to the next slide. Here we are again. A little bit of background. I'm an estate planning attorney, a trust and estate attorney. Since 1977, which is a lot of years. I'm a certified specialist in estate planning, trust, and probate law, which is a California board certification. Our practice involves the transfer of assets to the next generation and to others, sometimes charities. So we prepare wills, trusts, estate tax returns, handle trusts when they need to be administered after a death. We handle probates, gift tax returns, on and on. Everything that has to do with the transfer of assets and planning for those transfers. Daniel, please introduce yourself now.
Thank you. So I'm Daniel Wilson, and I'm also an attorney, and I'm a board certified specialist in estate planning, probate, and trust law. I also have a master's in tax, and so I'll be going into my 9th year of practice now. And in case for maybe some of you that don't know, Roberta's my mother, and we practice together. She's really just on the opposite wall from me, but we figured out it'd be better to do the Zoom in our own offices. And yeah, so we've been practicing together, and it's been quite a year, again, to say the least. And so we're excited to be able to reach out to you and let people know, what's going on, especially with the election. Is there something you should be doing, thinking about, or coming in to talk to us about? And so today on our agenda, we're really going over 2 major categories: the California election and what developed from that, and also the federal and the presidential election and what could come from that. And so many people are probably thinking we're just talking about, what happened in the presidential election and with Congress, but believe it or not, the law actually did change for California property taxes that we feel is more significant than speculating about what could happen in the future. And so really we want to impress upon you how important this is to talk about it first, because being in California, especially most of you in Southern California, property taxes are a big deal. And so we're going to jump into what changed in the realm of California property taxes. So for some people, believe it or not, we just passed California Proposition 19. And if you were interested in which proposition this is and how does it affect property taxes and estate planning, it was the one that was called the Home Protection for Seniors, Severely Disabled Families, and Victims of Wildfire or Natural Disasters Act. So this was the one that, if you read maybe the first couple of lines on the proposition, it allowed an individual who's 55 and older to buy another home for themselves and then transfer their property taxes. Sounds great. Similarly, if you were severely disabled or a victim of wildfire, you could do the same thing. And also the money is going to go mostly to wildlife relief funds. So it looked great if you read those first couple of lines, but how does it affect estate planning? Really what it did also was have a major change on what happens when California real property passes from a parent to a child or children or even grandchildren. And so we're going to go over how this affects those people and really what to do about it, or what should you be thinking about doing, because in this case, the hard and fast deadline of planning right now is going to be February 15th, 2021. So we're telling people just think about it like Valentine's Day. That's the deadline. So in this case, it's not end of the year, it's actually you have until February 15th. And so in order to really understand the effect of the change, we're going to go in our time machine and talk about California property taxes.
So come in the Wayback Machine. Who remembers the Wayback Machine? We're going back in time to 1978. I was a brand new lawyer. I was in my first year of practice. I might not have even realized how significant Proposition 13 was. Well, what was the environment in the 1970s? Here in California, we were living through a period of great inflation, and real estate values were going up, up, up really fast. The assessed value, what's that? That's the property tax value that the county assessor puts on property. The assessed value was also going up and up and up without limit. So everybody's annual property tax bill was going up, and people were getting upset. They couldn't afford to live in their homes anymore. Their rental properties, their cash flow is going down. So there was a taxpayer revolt. You see my picture here. We had a lot of people revolting. They were led by Howard Jarvis. For those of you who remember living in California, this was really big. So Howard Jarvis got enough signatures to put an initiative on the ballot to try to limit the increase of assessed value. They couldn't limit the increase of fair market value. That was going to keep going up. But they wanted to limit the increase in assessed value because the property tax is based on that assessed value. And if you look at your property tax bills, I should have put one up here, but if you look at it, you're going to see a lot of information on your property tax bill. On the right-hand side, you're going to see the land, the building, on, and finally you come to your assessed value. That's the number that they were trying to limit from increasing too quickly. So it passed back in 1978. Let's go to the next slide. Here we see the limitations. The assessed value would result in a tax of about 1%. So putting it simply, on $100,000 of assessed value, there could be a $1,000 annual tax bill. Who remembers what properties were worth back in 1978? a lot less than right now. The limit on how fast the assessed value could climb was 2% per year. Again, fair market value could zoom up, but the assessed value would just crawl along at 2% per year. And you better believe I have my budget and my spreadsheets. Every time I get a tax bill, I look and I calculate, did they increase my tax bill more than 2%? I want to see, did they do it right? Inevitably, my county is always doing it right. They've never gone over 2% a year. So that means you could have a very low assessed value right now on a property with a very high fair market value. So I'm giving you an example here in the picture. Here we have a 100-year-old house in San Francisco that's been in the family for decades. Well, the assessed value might right now be, for instance, $300,000 or $400,000. And the fair market value could be $1.5 million. But still, the Prop 13 tax base is used, and this family has a relatively low annual property tax bill. So we've had a good ride since 1978 on property taxes being limited. If there's a change in ownership, that's the hot potato. If there's a change in ownership, the property can be reassessed up to fair market value. So what is a change in ownership? That's going to be something that we're really thinking about. Is every transfer a change in ownership? If I sell it to someone, clearly that's a change in ownership. What if I leave it to my children in my estate? Is that a change in ownership? What if I leave it to my sister? Is that a change in ownership? So as lawyers, we're always trying to define what is a change in ownership. We don't want the change in ownership. We want exclusions from the change in ownership, because so there is a transfer and it's excluded, Proposition 13 still applies, and that slow snail's pace 2% per year increase still applies. So let's go to the next slide. Well, there were a lot of things that were changes of ownership. We weren't happy about it. And in 1986, so that is 8 years after Proposition 13 was passed, suddenly there's a new exclusion, again by proposition, by the voters of California, the residence exclusion. If a family falls within the residence exclusion, there won't be a change of ownership even when a deed goes to a new owner. That's a good exclusion. What does it say? It says there's no reassessment on the transfer of a personal residence to children. So we could have someone with a very modest house who leaves their house to their children. Maybe they have 3 children. It's the residence, it's going to 3 children. That person's passed away. We do a deed to the 3 children, and we report to the county on something called a preliminary change of ownership report. We report that we have an exclusion. We have an exemption from a change of ownership. What is it? It's the transfer of the residence to children. We call that the parent-child exclusion, parent-child. And for those of you who are watching who may not have children, you'll be thinking, oh, that doesn't necessarily apply to me. And you would be right if you didn't have children. If you have a parent who might be transferring property to you one day, think again. There might still be a parent-child exclusion that you're going to be worried about. Well, that's nice on a modest house. What if it's some gorgeous house in La Jolla? Think of, the nice, I've gone on walks where I see these beautiful homes in La Jolla, and a parent may have been living there for decades and decades and decades, and they're paying property taxes based on their Prop 13 tax base. They could transfer that gorgeous home to those 3 kids, and there would be no reassessment because there's no limit under Proposition 13. How valuable could that house be? So this parent-child exclusion has been just tremendous. And when we meet with children after a parent has died, this has been going on for decades, and we say, what is your plan for that house? Oh, we're going to sell it. We're going to get the money, you know. I go, it's the family home. Oh, we're going to sell it. We want the money from the home. And I said, do you know that you could keep your parents' Prop 13 tax base and keep paying their low property tax bill? And they say, ooh, wait a minute. And they reconsidered, should they hold on to that property, either as a residence or make it into a rental property? Because if they could keep a low property tax bill, that's like a hidden asset, that you still have a low property tax bill. So that was the residence exclusion the way it was in 1986 until now. That's a lot of years. So we're used to practicing law in that environment. Let's go to the next slide. Okay, I have to see them because it's still my slide. We broke up the slides this morning. It's still my slide. Also, under Proposition 58, back in 1986, there was a second exclusion called the $1 million of other property exclusion. You know, this is written by lawyers. That has no pizzazz. $1 million of other property. What is that? What if mom owns a rental property? Maybe it's a condo that has been owned for quite a while. Maybe it was the first home and that was bought way back when, still held on to as a rental property. What if mom and dad own some real estate, some commercial real estate, maybe an industrial building somewhere here in San Diego, and it's being rented out, commercial property? What happens to the tax base of that? Is that going to be reassessed? Is there any exclusion for that? Well, again, we're inside of the parent-child exclusion. Part 2 of the parent-child exclusion said under Prop 58 that there would be no change of ownership. In other words, no reassessment on other property, rental or commercial property being transferred to children for $1 million of assessed value, not fair market value, but property tax bill value. So if you had a commercial building or rental property, you pull out your tax bill and see how much is it valued at on the tax bill. If it was under $1 million, that property could be transferred at life, during lifetime, or at death to children, and they would get your Prop 13 tax bill. There would be no reassessment up to current value. So for instance, a commercial building that might have an assessed value of $800,000, maybe there's an $8,000 tax bill being paid every year. If it was reassessed at fair market value, which who knows, let's say it's $3 million. Am I at $3 million? Then our tax bill would be what, Daniel? At $3 million, 1% of $3 million, $30,000.
Yeah.
Huge, huge change.
Per year.
Per year, every year. So we would say to clients, pull out your tax bills. We need to make a spreadsheet of all your other property. Let's see what your assessed value is on all your other property. And then we would see, is it under $1 million? And if we had 2 parents, remember, we would have $2 million of exclusion. If it was over that amount, the county would let us allocate the exclusion to various properties in whatever manner the taxpayer wanted. They could completely put it on one property, put it on half a property and another half a property. So this was a whole science, how to allocate the $1 million of other property exclusion. All right,
Yeah, and again, we're really trying to, the reason we spent so much time going over the history of property taxes is we're really trying to show you what's changing. And so for some people, again, like Roberta said, the children come in, didn't even know about the parent-child exclusion to begin with. So for some people, they didn't know that this even existed. Even for certain clients, we're teaching them that this is how property taxes would pass in their estate plan, meaning, but again, all of this is going to be changing in a couple of months. And so we want to see if any of this would affect you personally and whether there's any planning that should be done. So that brings us to Proposition 19. And so this is what passed just a couple of weeks ago. And so the old rule said between a property passing from a parent to a child, there's no reassessment in property taxes of the parent's principal residence, an unlimited amount. So again, they could be $100 million principal residence, and the assessed value would stay the same if it was going to the children. Similarly, another $1 million of other property, the assessed value of other property, so it could be a bunch of little rental properties, could also pass to the children without reassessment. And it was pretty easy to qualify for the parent-child exclusion. However, Proposition 19 passed, so starting in February 15th, 2021, again, think about it like Valentine's Day, what's going to be the effect if at that time parents are passing properties to children? Still no reassessment, but it only applies to the parent's principal residence passing to a child who then maintains that property as their own principal residence. So again, the idea that it could just be all these properties passing to children and they can do whatever they want with the property, they can rent it out, do an Airbnb, whatever they want to do, that's gone away. So the exclusion has been very much narrowed to a very small subset where, again, it's only the parent's house, and then if a child decides to live there, then does the property not get reassessed for property tax purposes. All the other situations, the property will be reassessed. So again, any other property that the parent didn't live in will be reassessed upon their death, even if it goes to the children. And then their house could be too, if the child, one of them or multiple children, they don't live there. And not only that, but the amount of that, when that exclusion does apply from a parent to a child under Prop 19, still only a certain amount of the property taxes will be excluded. And so if the value above the assessed value and the fair market value is more than $1 million, even if the child decides to live there, it will be partially reassessed. And there's a whole formula that we would go through. So again, this is a pretty big deal. And we've already had, again, it's only been a couple weeks. We've already had, I don't know, between the two of us, like a dozen discussions with clients about what does this mean for you? And again, the big deal is this comes into effect, again, February 15th, we're going to keep saying it, because you may have an option to do something about it by then if you're worried about property taxes. And so just to give you some examples to really show how big of a deal this is, because again, property taxes are something that get paid every single year, as you know. And so if there's a reassessment, it's that new number every single year that children decide to keep the house. So here's a nice simple example, and this actually just came up in a discussion with someone. So let's just say, a mom buys a house in 1990 for $200,000, and that can get you a lot of house back then. So property taxes have gone up a little bit every year. Mom ends up paying about $3,000 per year in property taxes. And let's say when she passes away, the property is worth $800,000. Again, not crazy numbers, because this is, many of our clients could easily fit into this fact situation. So again, before Prop 19, if mom dies, leaves the property to the children, they can take the property and not have to worry about any increase in property taxes. They don't have to live there. Again, if there's more than one child, they can sort of rent it out, share in the rental income. They have a lot of flexibility on what they're going to do with it. However, after Prop 19 comes into effect, if a child decides not to make that property their principal residence, then the property, if they decide to keep it, gets fully reassessed to about $8,000 per year in property taxes. So just in a 10-year period, the children would end up paying $50,000 more in property taxes. So that's a huge jump in property taxes that the children would have to pay. So again, when now going forward, of course, we're in the really planning window of opportunity phase. But let's say, middle of next year, when we start talking to clients and they come up with a distribution plan of their estate, we'll have to constantly remind them that if you have real estate and it's passing to children, as far as what do you want them to do with it, if you wanted them to keep it, or you're thinking that this would be something that can be passed down for many generations, we'll have to remind them, property taxes are going to go up. And so if that changes the analysis or the cash flow, it is really something to be considered. Another example. So again, let's say in this situation, mom maybe moved to San Diego back in 1980 and then bought her first house. Back then, $100,000 would probably really get you a big house, and decided that it's going to be, she'll buy another property, but she kept the original house from 1980, kept it as a rental property, and it's now worth $700,000 at her death. And so she's been paying property taxes, let's say about $2,000 per year. Now when mom passes away and leaves the rental property to the children, again, no matter what, now that Prop 19 is coming into effect, it will be fully reassessed. If it wasn't mom's principal residence, even if a child decides to make it their principal residence, it doesn't apply. So again, Prop 19 is very narrow. It has to be mom's principal residence, and the child makes it their principal residence after mom's death. That the property would be reassessed to that $7,000 per year. And so again, now the children are paying $70,000 more in property taxes. And so for even the clients with, sort of a modest estate of maybe a house and a rental property, this has huge implications for them, when before on the estate planning side, we didn't have to spend so much time on it. It really, the law was, just property taxes transfer to children, no advanced analysis or planning around it. But now all of that has changed.
So here's the balloon. We always see balloons in San Diego. This is the $1 million exclusion floating away. How can I make this point any stronger? So now, once Prop 19 goes into effect, all real estate will be reassessed up to current value when it is transferred, even from a parent to a child, except for the exclusion on the residence that will continue to be used by the child as a residence. And by the way, a family farm. We haven't gone into the family farm, but now I'm thinking about, could some of these Escondido properties be a family farm? I want you to know what a historic change this is, that Proposition 13 has finally been, damaged or limited. We've had it for so long, but now things are going to change. Next slide, Dan.
Yeah. And actually, so we are getting some questions in the chat or the question and answer. So feel free to submit questions. And usually if you come to our presentation, we like to be really interactive. So if we can answer them along the way, we will. We'll also save time afterwards for questions and answers. But again, if we don't get to it or questions pop up, again, part of the whole purpose of this presentation is, if you have questions, to let us know. And so give us a call or email us after the presentation. So Roberta, I'll ask you. So one of the questions is the $1 million exclusion for one property, or can it be for multiple properties?
It's per, I hate to say it, decedent or transferor. It's per parent. So as a parent, I can leave or transfer $1 million of assessed value to children up until a certain date, and then it's too late. And it's not per property, it's for me as an individual. So that is the limit on the $1 million exclusion.
So if you have a bunch of little houses in Claremont Mesa, Rancho Bernardo, Mission Valley, if you added up all those assessed values, on the property tax bills, if that was under $1 million, all of those properties could have been passed to the children without reassessment. So it could be, again, $1 million per person. So for a married couple, $2 million of assessed value, which is a huge amount of property. If you've been here a long time and you bought property before it is what it is today, that could be lots and lots of properties.
And Daniel, I think we do need to make the point, we're talking about real estate that is owned individually or in your revocable trust. If real estate is owned in an entity like an LLC, there are completely different rules that apply to transfers of real estate held by an LLC. So this is for individuals or revocable trusts owning real estate. One of our questions here is, what about a timeshare in California? Well, timeshares might be real estate or might not be real estate. In some timeshares, you're actually given a deed and you own a fractional interest in real estate. In other timeshares, you have a membership interest only. So if you have a deed to the timeshare, yes, that new law applies to the timeshare. So the most important slide here, urgent action by February 15th. So the law changes literally on February 16th, but I want you to remember February 15th, the day after Valentine's Day. That's the last day you can do a transfer under the old Proposition 13 rules. The residence of unlimited value to children who might not use it as their residence. The $1 million exclusion on rental and commercial property. There's something that can be done if the transfer occurs very last day, February 15th. Think about Valentine's Day. Well, what should we do? We always get this call right away. What should we do? The law just passed. We're trying to figure out what are the questions, let alone what are the answers. So let's think about some of the things that are going through our mind. Should a transfer be outright to a child? What if I deed a rental property right now to a child? Well, clearly that qualifies. Either if it was my residence or if it's rental property, it's going to capture the old Proposition 13 rules. But maybe I don't want to leave it to the child outright. Maybe I still want to have some control over that property. Should I put it inside of an irrevocable trust? Should I be the trustee of that trust? As long as the trust provides for a child, it's eligible for the parent-child exclusion. What if I'm concerned with still getting the income from that property? Should I transfer the property to a child who puts it in an LLC and names me as the manager of the LLC, and I receive compensation for being the manager of the LLC? So you can see that what you're trying to achieve, you don't want unintended consequences. You never want anything unplanned. How long do you need the income? Do you need that property in your estate to care for you during the future? We've lived through inflation. We've talked about the property that was once worth $70,000 is now worth $700,000. We have very long life expectancies now. So you have to plan for yourself. So right now, everyone should be focusing on the questions, and you'll see more and more in the news and from us about what is the planning that can be done. The other thing is that you're going to want to review your existing estate plan. Did you say that a certain property goes to a child? Or would you like to say that a certain property goes to a child? Maybe the house that's going to be used by your daughter as their residence. Maybe it's important to put it in there. And Daniel, can I ask you, we haven't made it a slide, but when it comes time to distribute a trust or an estate, and it just says everything goes to my 3 children, is there a way to allocate one property to a child?
Right. So on the estate planning side, and whether or not many of our clients knew we were doing this on the back end, when we ask you for all of your assets and, what are their values and everything, we're coming up, for you, not just a nice distribution plan to make sure everything happens the way you want it to, but we're also always considering to make sure it's tax efficient, whether it be capital gains or income taxes or especially property taxes. In our minds, we were always thinking about that. And sometimes, if a parent had a property as part of their assets and they wanted a specific child to receive that property, but they don't have really other assets for the other children to get, but they still wanted to treat them equally, we would write it into the estate plan to say, this child gets the property, the other children get cash equal to, their share of the estate. And if that wasn't enough, there wasn't enough cash in the estate to satisfy that, we set it up so that the child who's getting the property essentially can purchase the property from the trust or really get a loan against the property so that they could qualify for that parent-child exclusion. Again, back then, whether or not they lived in it didn't matter. So it could qualify for the parent-child exclusion, and then everybody else, all the other siblings or beneficiaries, get an equal share of the estate. So those are the types of estate plans that we're going to have to really sit down with, because the whole purpose of doing all of that was to preserve property taxes, but it may not work anymore for in certain situations. And I really like the questions that we're getting, because some of these things we couldn't necessarily put in the slides as far as the information goes. And I think the way the legislation was written, there's going to have to be a lot of information that comes out afterwards. So when dealing with property taxes, it comes down from the Board of Equalization. So they're going to have to give guidance to attorneys or people on what does it mean for Prop 19? How does it work other than just the text on the page? As an example from one of the people in the chat room, this is my thought is, well, when you say the principal residence of the parent can go to the child who maintains it as their principal residence and keep the same property tax bill, how long do they have to live there in order to preserve the parent-child exclusion? So for property taxes, how long do they have to live there? If they make it their house and it keeps the low property tax bill, if they decide later to move out, does that mean the property taxes are going to go up? We don't really know. The way the law was written, it says the child has to maintain the property as their principal residence within about a year after the death of the parent. And the way you claim that is your principal residence is you make the homeowner's exemption claim when you're filling out your property records. And that's really all that needs to be done. And so you would potentially fill out that form and live there as your principal residence if you're the child receiving it. But it doesn't necessarily say whether that keeps the property tax bill suppressed until they move out, or that's it. You just filled out the form once, you live there, and then if you decide to move out later, I don't know, 6 months, a year, you move back into your own home and now decide to rent out that property, do you keep the same property taxes? It seems that way, but we don't have exact guidance on that. And so that's something that will be coming, again, likely we're in the window of planning before Prop 19 comes into effect. And so after, again, Valentine's Day, we'll be dealing with the after effect of how does it actually get interpreted, or practically what do we do after the death of a parent. And other questions that are coming in, let's see. Right, other planning options. What if you just add a child onto the property? And if you've ever talked to us about that, we're pretty good about talking you out of it for many reasons. But more likely, let's just say, what if you're thinking of making a gift to the child of the property now before Valentine's Day? What happens with that? Well, what are the pros and cons? If you're really just worried about taxes, there's actually a huge trade-off in taxes. So if you make an outright gift today of a house to a child, the parent-child exclusion applies. That disappearing $1 million that's going away, hey, let's just use it up right now so we don't have to worry about it, because by Valentine's Day, it won't matter anyway. So let's just do it now. Get the child their inheritance early. Well, what's the effect of that? Now we're thinking of income taxes. So here's the trade-off. When you own a property, let's say it's a rental property, generally you have your cost basis, so what you paid for the property, and then you have what it's worth today. And many people know if you sell a property, you're paying the tax on the gain. Instead of selling the property, if you die owning the property, that cost basis goes up equal to date of death value. So if you die owning the property, stepped up basis, and then it transfers to the children. When they get it, if they decide to sell the property, great. If they sell it for that price, no tax on the sale because there's no gain. If they decide to keep it for a period of time, again, they keep your same property tax bill before Prop 19, they keep the same property tax bill. But if they decide to sell it and they pay the tax on the gain, it's only the appreciation from date of death to date of sale. So for some people, it makes sense to die owning the property because there's so much appreciation that it would be burdensome on the children when they decide to sell the house if there wasn't the new basis. If you gift the property to the child in their lifetime and there's the gain in the appreciation, the children take the cost basis. So it's called carryover basis. So you gift the property to the child, they keep the same basis. So if they ever sell the property in your lifetime, after your death, any period of time, they're paying the tax on the sale. So what you're giving up, just if you look taxes to taxes, you're preserving property taxes, but you're giving away the stepped up basis. So it's one of those situations that when we're talking with clients, like we're already doing now, we have it on the books, we're having them give us, their property tax bill, their cost basis, what's the fair market value of the property, and does it make sense to do anything about it now? Because you really need to know the numbers. Not only taxes, practically, kind of like Roberta said a second ago, are you going to need the income from the property to live on? Technically, if you give it away, you don't have a right to receive the income. But there's, planning options around that. But again, what if you give it to a child? It's now subject to their creditors if they ever get sued or go through a divorce. So again, you give a gift to a child, it's their assets. If they go through a divorce, you could be subject to the division in the event of a divorce. So these are all the pros and cons that we'll be going over with clients, and I think a lot in the next couple of weeks here. Okay, so we'll save the other questions about this, right? Because individual questions, again, let's just have a sit down and talk about it. What should you do? Okay.
All right, everyone, we are leaving California. We're going nationwide. We're going federal. So I remember in taking exams in college, I would get all ready for the exam and then try to dump out all the information after the exam so I could deal with the next subject. So put away all your California thinking. Now we're going federal. I'm going to go over in general, how does our federal transfer tax system work? And then we're going to talk about what might be developing. We have count them three transfer taxes. We have the estate tax. That is transfers at death. I was watching The Queen's Gambit on Netflix, and I loved when they would, put down the chess piece. So there you go, somebody's died. So it's at death. That is a tax that occurs after a death, 9 months after death. We call it the death tax sometimes. What about the gift tax? Those are transfers that you make during your lifetime. There can also be a transfer tax at that point. And what about generation skipping taxes? Something we don't always think about. This is a transfer that skips a generation. You're going down to a much younger generation, such as your grandchildren. So our transfer tax system is based on these three sets of taxes. Next slide, please.
And again, the reason that we're talking about this is, again, we had the federal, presidential, and congressional elections that just came to pass. And so we'll talk about what we know the law to be today, and then potentially what could the changes be down the line. And we tried to put this presentation out as far as possible so we could at least know who the president is. But not only that, also the congressional races. Still, we have a runoff election in Georgia for 2 seats in the Senate. And who would have guessed that, here in San Diego, our California estate planning law firm is going to be so focused on what could happen there. because the outcome of those runoff elections, which unfortunately it's not till January, that it could dictate how we plan your estates in the future. And we're going to talk about that. Okay, so here is what we know today. So again, when we think about taxes, on the estate planning side, the biggest one is going to be the estate tax. Some people call it the death tax. We call it the federal exemption amount. So really what we're thinking is how much can you own that you die with and then is not taxed in your estate at your death. So before anything gets to the kids or the other beneficiaries, if you have a certain estate, it could be taxed. So what do we know for sure? Well, we know the current exemption amount for this year, 2020, is 11.58 million. And we know for sure that at the end of 2025, that amount is going to be reduced to about $6 million. So to go through the history, we know in 2009, the exemption amount was $3.5 million per person. In 2010, there was actually an unlimited amount you could have in your estate. There was kind of a gap in the law. And then finally, in 2011, the exemption jumped up to $5 million. So that $5 million in 2011 is really the most permanent number we have in our estate tax system right now. And so what happened is exemption amount was $5 million. In 2017, 2018, under the Tax Cuts and Jobs Act, the exemption amount was doubled. So it went from $5 million per person to $10 million per person. And then it's adjusted for inflation. So that's how we get to that kind of funky number of 11.58 million per person. And when I keep saying per person, the reason is between a married couple, you can combine your exemption amounts. So here we have, let's just say $11.5 million per person this year. Between a married couple, you double it up, $23 million can pass free of estate taxes. And so we haven't really had to do a lot of estate tax planning because so many people are under the exemption amount. They see these numbers, they're so huge, they don't even think about it. But look back in 2009, it wasn't that long ago that the exemption was much, much lower. And then again, so the exemption was doubled and it's actually set to expire. So we have the laws that were passed are called sunsetting laws. So they couldn't be made permanent, so they could only be made temporary for the next couple of years. So at the end of 2025, that doubling goes away. So it goes back down to $5 million, and it's still indexed for inflation to like 11 years. So that's where we're estimating it to be, about $6 million. So for a married couple, $12 million going forward can be left free of estate taxes. And that's what we know for sure. Anything amount over the exemption is going to be taxed at 40%. So again, not only is it important to know, why is this such a big deal to look at, that 40% tax is just so large, and it has to be paid within 9 months after the date of your death. And so for a lot of people, again, we haven't had to do estate tax discussions very long. It could be, 20-second talk, but that could change. And so again, there's another illustration. You're flying off into the sky, showing that for sure, we know that the exemption will go down to about, again, $6 million per person. And so what should be done about that? We'll really be taking a close look in the next couple of years about how to plan for that. But in the interim, could the law change even sooner than that? Just because we know it's sunsetting at the end of 2025, doesn't mean that the laws can't be changed sooner. So again, with the election, that's what we're taking a really close look at.
All right, so those were transfer taxes. If your brain isn't full, I'm going to talk about another tax, which is income tax and income tax basis. And Daniel has reviewed this a few minutes ago, but let's do it one more time for the big concepts. What is my basis during my lifetime, my income tax basis? So let's say I bought a home, I paid a certain amount of money, that's my cost. And in the meantime, I added on a room, I added a pool, And now I'm going to just use my imagination for everything I'd like to do. New granite countertop, etc. I've made improvements to the property. My cost basis is what I paid plus all my improvements. And if it's a rental property, I get to take it down a little bit by how much I've depreciated. But my cost basis is kind of going back to my acquisition cost. So here's my busy bee. Here I am, a busy bee. I'm building my home here. I'm putting honey into it. All of this buildup in value is gain. And if I sell during my lifetime, I report what is my cost basis? What have I built it up to? What am I selling for? What's my fair market value? And all of that gain can be subject to income tax. And we know there are many, many laws to deal with how do you get out of your income tax on capital gain, but that is your lifetime gain if something is sold in your lifetime. But let's say I hold on to that property till my death. Then what happens? And you'll see here these birds on a wire, totally free. They don't have anything to worry about because at my death, there is a new basis on the property. Fair market value becomes the automatic new basis. So if I leave that home to my children and they sell it the next day, you know, maybe they'll feel bad for a little while, but let's say they sell it a little bit later, they do not experience my lifetime gain. There is no tax on my lifetime gain because they take fair market value at the date of my death. Very interesting. And when we're working with families and they haven't thought about that and we're distributing an estate, you know, their eyes pop out. Oh my gosh, they've got a new basis. I'll tell you what doesn't get a new basis, just because this is the other half of what I always have to tell people. All of your retirement plans, your IRAs, your 401ks, no new basis on those assets. When those are withdrawn, they are subject to income taxes. So we had lifetime basis, we have basis at death, and we have a third consideration, which is basis of a gift. So I have that same home. Let's say I give it to my children. What happens to the basis? I'm giving them the basis. So there's that busy bee. I'm giving them the honeycomb with all the buildup in value. So they can hold on to that investment. When they sell it, all that capital gain will be subject to income tax. So in estate planning, we do worry about transfer taxes. We also worry about these income taxes.
And so,
Daniel, go
yeah,
ahead.
We're going to look at potentially, the reason we bring these up is in a way on the estate planning side, that's what's on the table. So that's what people are concerned with, that these rules, income tax basis and the estate tax exemption amount, is that something that could be changed with a new sheriff in town? So again, part of the question is, which is outstanding, is how would these laws change? And I can go through my civics class if I remember it. But it does take an act of Congress and president to change the legislation. As far as the makeup of the Congress goes, right now we have, with the Georgia runoff election, we have 2 seats outstanding, and we have about 50 seats, 50 seats for the Republican Party, and then 48, or really 46 plus 2 independents for the Democratic Party. And so we have 2 more seats up for grab. And let's say both of those went to the, the Democratic candidates, then it'd be a 50-50 split with the vice president being able to be the tiebreaker. And so with a presidential president-elect and vice president, potentially there could be some significant changes that they have on their agenda. So what we tried to do, without speculating on everything, is what have they talked about making changes on in the estate tax realm. So the first one would be under the estate tax exclusion. Could they lower the exclusion amount? Next, which would be pretty radical, is repealing the stepped up basis at death. So that would be huge. And it's been talked about before. Again, nothing's passed on that. but this is just something that's we're going to be on the lookout for, and will affect how we, again, how we plan for estates, and then potentially how we kind of really think about estate planning overall. And so what would the proposal be to lower the exclusion amount? Again, right now, the exclusion amount is that 11.5 million, so it's very, very large. President-elect Biden, and then we try to show you the source on their website, said he would like to lower the exclusion amount to what it was in 2009, which is $3.5 million per person. Again, still combine that for a married couple to get you $7 million that could pass free of estate taxes. You know, not so bad for a lot of people. They're well under the $7 million amount for a couple. But there's also a good amount of people that are above that amount. And so they're really going to be interested in seeing if this is something that could come to fruition. And not only would the change be to the exemption amount, but also to the tax portion. So the amount that gets taxed over the exemption right now is 40%. Back in 2009, it was 45%. And then Roberta, do you remember any time in history that it was even higher than 45%?
Oh, now I'm going in the Wayback Machine. When I first started practicing law, who can guess how high the rate of the estate tax was? It was 70%. Income taxes, highest rate was also 70%. And that changed when Ronald Reagan came in. And we got more in the range of a 55%, 50% estate tax rate. So when I see the 45%, I'm thinking, oh, it's not that bad. It used to be quite a bit worse.
Right. And again, so we know the rates in 2009, that's what's sort of the platform here. But of course, you know, would there need to be a compromise? And that's where President Obama had the compromise in 2011 of $5 million per person. So when they were trying to pass legislation, you know, estate tax was kind of on the table as a chip to be bartered with. And so even if there is, let's say, a split Congress, or even more so if, you know, the Republican Party has more seats and have a little bit more weight, that they, you know, all this proposed legislation isn't just going to be passed through, you know, according to their wishes. There's going to be a little bit of opposition where maybe we'll end up somewhere in the middle. The problem here of, you know, what we don't know is, again, this will all happen next year, next calendar year, that potentially some legislation could pass. In that case, likely it wouldn't become effective until January 2022, because the law passed in 21, so they would have it enacted the following year. But what if, worst case scenario, they make it retroactive to January 2021, and that there's no way to plan around that. We're already, you know, past that time. This is not till June or July that this gets passed, but it's made retroactive. So in a way, that would be the worst possible outcome, because on the planning side, it's too late to plan. And so that's something that for clients that are concerned about all of this, we're going to be talking to you and going over, you know, what can you do about that? Other proposals, again, we talked about the lowering the exclusion. Next is, could they actually repeal stepped up basis? And so that's would be a big deal when children inherit money, that instead of being able to liquidate the day after death, not pay any taxes, that wouldn't be the case anymore. So all that appreciation in your lifetime stays with the assets. So when it goes to the children, they're not necessarily paying a tax on receiving it, but if they decide to sell some of those assets, they are paying the tax on the gain, even that you had in your lifetime. So they don't get that benefit of the stepped up basis. And even a potential harsher outcome is, what if instead of a stepped up basis, death is called a gain recognition event? So that would be the situation where just because you died, all of the assets stay the way they are, but your estate is taxed as if the assets were sold. So whether or not you sell the assets, they're still taxed as if they were sold, all at the time of your death. And so that would be another severe tax. And again, it's sort of all up in the air right now. We don't know. This isn't necessarily even on the table. It's just been mentioned on his website and his campaign. And of course, with politics, you know, it's really hard to say what the likelihood is of any of this actually being passed. And so what can you do about it? That's kind of the $1 million question here, or in this case, I don't know, the $3.5 million or the $5 million question. What can you do?
And what we're going to see is what I call a return to classic estate planning. Tools and techniques that we used really for decades before the exemption became so high. So I say we've been lulled to sleep. You see this little kitten fast asleep, nothing to worry about. We've had 15 years of increasing exemptions. So the transfer exemption, transfer tax exemption went from 5 million to over 11 million in a decade. So we've just, have we been asleep at the wheel? We're feeling so comfortable like this kitten. And by the way, that exemption is an exemption at death, or it could be used for gifts right now, or it could be, it could be used for transfers to lower generations. So this exemption that we have right now, 11.58 million, I can make a big gift right now and use up part of the exemption. And at my death, I can use part of the exemption. What's interesting is that in order to use our big 11 million plus exemption before it goes down to 6 million, I would have to give away over 6 million in value to start eating into that exemption that's going to go away. So in very, very high net worth estates, people should be considering very large gifts to use up their exemption. Now here comes the lion, that's our tax lion roaring back to life. We know that the transfer tax exemption that we're talking about is going down. We do not need our Congress to vote on a tax bill. It's written into the existing tax bill that the exemption is going to go down to about $5 million in 2026. It's already there. We are in a changing tax environment. And as Daniel pointed out, we could go down maybe to a $3.5 million exemption under a new tax bill. So what do we know? It's now the time to plan. It would be great if we didn't have any unknowns, but we do have unknowns. And if you're a young person, you have maybe a longer horizon for planning. If I'm in my 90s, I have a shorter horizon for planning and things are more imminent. So how we plan for people depends on their circumstances. Daniel, would you like to take any more questions right now?
Sure. So if anybody wants to fill out a question in either the question and answer or the chat, we'll try to take a couple of them. So let me see. As far as property taxes go, so if a parent holds title in an LLC, are the transfers to children rules not applicable? Roberta?
Oh, thank you very much.
Yeah, I'll ask you the question.
So an LLC is an entity, and the entity rules are different than the parent-child rules. I'm going to tell you in general what are the entity rules. If real estate is held in an LLC, if there's a transfer of 50% or more of ownership or control, at that point, there can be reassessment. That's a whole world in itself. It may come into our world because we're going to be transferring property to children, but parents are still going to want to maintain some control and have some cash flow. But remember the balloon that's going away, the 1 million exclusion that's floating away, that has to do with transfers between parents who own property themselves or in their revocable trust, not inside of an entity. and it has to do with California real estate only. I saw a question here about Nevada real estate. So Nevada isn't affected by our California law. And it's interesting, our California law has been very beneficial to property owners all these decades. I was often hearing about what are property taxes in New York and Connecticut. Huge, huge property taxes. So we have been in a wonderful position for all these decades, having Proposition 13. And now we're waking up. We're going to be, I guess, in the real world now. Our state is in need of money. And what would have been coming in increasing property taxes for all these decades has been somewhat suppressed. So we're going into a new regime right now.
Yeah, the few things we actually got to be proud of in estate planning was talking about, property taxes being passed to the children, capital gains step up at death, and some of those, nice things we get to tell people, are in jeopardy at this time. A couple other questions about property taxes. So what about property held in a trust, and how does that work? And so really any property that's in your general revocable living trust, so you create the trust and you're alive and it's just your family living trust, the property tax rules are the same. So it's almost as if it doesn't exist. However, again, getting back to our planning slide, we talked about what about irrevocable trusts. So it is possible for a person like myself, I could create an irrevocable trust and transfer property into the irrevocable trust in my lifetime. And that is one of the topics we'll talk about with clients that are worried about property taxes going up. Because the date you put the property in an irrevocable trust is considered a change of ownership. So for some people that may want to use that disappearing $1 million exclusion from property taxes may be creating these irrevocable trusts before Valentine's Day and putting the properties in the trust. And again, there's going to be trade-offs, pros and cons of doing both. So we'll sit down with you and talk about that. Let's see, other questions. Gift tax laws. So in just going over the gift tax rules, again, what do we know? We still have that, the amount you can give in your lifetime per person is actually tied to the estate exemption amount. So there's that $11.5 million. So we know for sure you can give $11.5 million away without having to pay a tax. Just file a gift tax return. You could still give that $15,000 per person per year excluded from even having to file a gift tax return. But, right, if there's a change in legislation, it will likely also affect gifting and gift taxes. Again, getting back to what did the estate and gift tax look like in 2009, we had the lower exemption of $3.5 million and the gift tax exclusion. It wasn't tied, and this was actually before I was in practice, so it wasn't tied to the exclusion amount. So now we know everything is gift and estate, the exclusion's the same. But back in 2009, we had a $3.5 million estate tax exemption with a $1 million lifetime gifting exclusion. And so again, when we're talking with clients, we're always going to think about, what are the proposed changes and how does it affect you? Let's see. And their questions, it looks like people are more interested in Prop 19 and property taxes. Right, so a question about, having irrevocable trusts for property versus your revocable trust for your other assets. Right, so that's kind of a big planning tool, is creating these irrevocable trusts and getting them funded, again, before Valentine's Day, I'll keep saying it, before Valentine's Day, fund those irrevocable trusts if it makes sense. Again, it's not going to make sense for everybody. Just this week, I've had 2 calls with clients that are in this situation where they have their house and a rental property, and they have 2 children. They want one to get the house, the other to get the rental property. But we said, are they going to live there in one of them or not? And they said probably not. They're both either going to sell it or be a rental property. And so we had to have the discussion of saying, well, you could do it now. Let's just say you give an early inheritance of the rental property, that they can keep your same property tax bill. But because of the carryover basis, the client didn't want to do it. It wasn't worth that. And so it's going to be, we can tell you all the pros and cons, but it's going to be a personal decision. But of course, we'll talk about it with your CPA and your financial advisor, because really we're talking about giving away a substantial amount of assets, real estate basically. And so it's not something that everyone can just, give away all your properties because you're trying to preserve taxes. There's a lot more that could go into it. Okay, and I think for now, we'll go ahead and stop the presentation. Again, anything else you want to talk about, call or email us. And we'll probably be doing a lot of work here before either the end of the year or by Valentine's Day. And so thank you for attending. Again, you'll be getting another notice of a webinar, our annual What's New seminar that we used to do every year at the Remington Club. We'll be doing it via Zoom, so you'll get a invitation from us. And we look forward to you seeing us again at that time.
Thank you.
Thank you, everyone.